Good morning from London. I'm Kriti Gupta alongside Guy Johnson. We're an hour away from the opening trade. Here's what you need to know. President Donald Trump pledged tariffs are still coming on smartphones, computers, and other electronics, downplaying a weekend exemption as a procedural step in his push to remake U.S. trade. And the dollar continues to weaken as worries around the U.S. trade balance and deficit pressure the Treasury curve and amplify those trade worries. How prepared is China in all of this? We're going to dive into the latest data as President Xi Jinping aims to woo Southeast Asian nations. Guy.
In honor of Rory McIlroy, there is an awful lot of green on the screen this morning. He wins the green jacket. And as you can see, markets respond. I joke, of course, we are watching very carefully what is happening with the tariff story. You've got Euro Stoxx 50 futures up strongly. Keep an eye on the tech trade today. That is where the centre of attention is likely to be. The Nasdaq is up by 1.45% in terms of the futures trade that we're anticipating out of the States. You've got the Euro bid as well. We're up by 0.2%. The dollar is definitely down this morning. That is one of the narratives we'll come back to. And the US 30-year, even the US 30-year, in honour of Rory McIlroy, is in the green this morning. The countdown to the opening trade starts right now.
Well, that's going to be announced very soon, and we'll be discussing it. But we'll also talk to companies. You know, you have to show a certain flexibility.
So some products there's flexibility for some products?
For some products, yeah, maybe.
The president's on Air Force One being asked about tariffs on iPhones. To be honest, Kriti, I'm pretty confused. So it looks like we're basically setting up for another week of massive confusion around tariffs, this time around tech tariffs.
But I guess if there's one point of clarity, it's that we know the sectoral tariffs are coming. So we know that in all the confusion that exists, at least there's going to be one kind of potential trading point that sectoral tariffs are coming. Was this part of the strategy? We don't know. But at the end of the day, if there is a bull case to be had, and I'm kind of clutching at straws here for the bull case, just given all the volatility, is that even just for the temporary basis, the number on some of these electronics are still less than 145%. Even with the fentanyl tariffs, even with the 20% and the 34% and all the numbers, it is still less than the 145.
Doesn't it just sort of act as a way of exposing just how embedded US tech is into China and how important it is and how problematic it's going to be, therefore, if Trump is determined and Besson is determined to isolate China from the US economy? They are so intertwined. Apple is so into China in such a massive way that withdrawing is going to be difficult.
So Tim Cook did a really notable job in the first Trump administration getting iPhones exempted from that whole China story. But in the meantime, diversifying away from China and creating the supply chain now into India that he can kind of draw on. He hasn't been so lucky this time around, even after attending the inauguration with several of his tech counterparts.
So I think it's going to be really interesting to see how long the bump that we get from the temporary part of this lasts, because it is temporary. Look, Nick said it, Trump said it. It clearly is, as you say, we are heading towards some sort of sectoral story here. I don't know, what could that look like? I have no idea what the number could look like, but it is going to be, it's going to raise the price of these products in the United States. So I wonder how long before that is the part that ultimately gets price in. Yes, it's not 145, but it could be a pretty punchy number.
It could be a pretty punchy number. The whiplash over the weekend when the markets were closed was unreal. I mean, it's just the moment of kind of brief optimism from the tech crowd, including the likes of Dan Ives, by the way, who went from Uber tech bull to Uber tech bear very, very quickly and then back again. I think it's also important that we're talking here about, and a lot of the analyst knows, I don't know if you've seen this, is you had this idea of peak uncertainty kind of in the rearview mirror. That peak uncertainty had already passed. And I thought that was really interesting because that phrase came up so much over the weekend.
I just don't know. I don't know. Are we heading for another week like last week? I don't know. What could go on here? I don't know. The volatility in the policy story is so hard to read at the moment. As you say, I'm almost glad it happened over the weekend, though. In some ways, all of this stuff should be limited to weekends so we can go through the arc of it all. And by the end of it, hopefully have some resolution. I'm not sure we have some sort of resolution here, but this stuff is coming out all over the shop. Mid-session, You've got a tech story over the week. Who knows when it's going to come out? It could come out at any moment. Clearly, there is still concern around the bigger picture, though. You could see that, I think, in the dollar this morning. The dollar continues to be an area of weakness. We do have a bid back into Treasuries at the long end, so that at least maybe is signs of some stabilisation. But you've got an awful lot of ground to cover this week. And it is interesting that the dollar story is still there as a negative, you could argue, in terms of how the market is voting on what Trump is doing. Basically, it is signaling that assets are leaving the United States.
There's the trade piece of it, which absolutely is weighing on the dollar. And we've seen that across U.S. assets as well. Then the idea of the kind of the deficit, the trade balance, all of these kind of fundamentals from, I would argue, September of 2023 has kind of come back into the conversation. We are counting down to that debt ceiling in July. We're counting down to that. This is the chart that I think is really important for our audience because you can just see how much investors are really hedging against further dollar weakness. You've already seen them gone neutral. You've already seen them quite bearish. They're saying there's more to come, at least when you look at the options market. Absolutely.
So the beneficiaries of this, I look at Europe. So the euro is trading strongly into an ECB meeting this week, which I think could be fascinating because it's an ECB meeting that could deliver a cut. So how does the FX market respond to a cut from the ECB? Is that something that takes the steam out a little bit of the euro story, or in some ways could it turbocharge it because the European economy is getting a boost at this point? Now it's obviously off a very low base, but it is getting a boost.
It's getting a boost in terms of the asset classes, but the European economy still has the same problems that arguably the U.S. economy has. They're still talking about deficits. They're still talking about overspending. They're talking about a supply chain issue. The narrative around the European economy is really a narrative shift around Germany specifically, and the idea that somehow the German fiscal spend will come to the rescue of the broader European economic story. But is that a temporary situation? The next 3 months, Europe kind of outperforms, and then it reverts back.
It's interesting. You look at all the investor surveys at the moment that are being done. People are saying we're going to take money out of the United States and we're going to put it to work in developed markets, which basically means Europe at this point. They're signaling out Europe as being as an investment destination for equity money in particular, and it's going to flow out of the United States and into Europe. And obviously that's a real money story that in theory should boost what is happening with the euro as well. Let's talk about China. I'm not sure how you read the data this morning. I looked at it first thing and kind of largely ignored it. Clearly there's been a lot of front running. There has been a lot of front running. Chinese exports are up way more than anticipated. That is understandable. This is March data. Imports are down, but it basically tells you about an economy that has front run the tariffs. The next set of data, I think, will be the interesting ones.
Yeah, the front running of the tariffs, but we've seen that in the data set for the last 3 months or so on the anticipation of that tariffs exist. I think the question around China is that they feel very prepared for this. They're looking to diversify. Xi Jinping is in Vietnam at the moment. He's on a tour in Southeast Asia to a lot of the countries, by the way, that are getting also hit by the tariffs in a very, very big way. He's also speaking to a lot of the European leaders. This was a conversation last week as well. At the same time, they're kind of pumping in this fiscal stimulus. They're keeping an eye on the stock market. There's a question of devaluation. The narrative that I've heard in the last week has been, do they or do they not sell treasuries? Are they going to be doing that? Do we know? I've seen it both sides. Some people saying it's already happened. Others saying, actually, the hard frequency data doesn't say it yet.
It just needs to do a little bit. Shirley Wren's written a nice piece about this today. Just a little bit here, a little bit there, just to keep the treasury market unstable. Just to kind of sell at just the right times. You don't even need to sell very much to freak everybody out because the market's so sensitive at the moment. Just want to factor in another part of the narrative as well. LVMH has got sales and revenue numbers down a little bit later on. I think the numbers will drop at about 4:40 London time. There's a call at around 5 o'clock London time. It's the new CFO on that call. It's going to be really interesting to see what LVMH says about what is happening in the United States, where it's highly exposed, what's happening in China. That kind of what happens with the consumer story, I think, is going to be really interesting. And LVMH, I think, will particularly give us an upper-end view of what is going on. But also the wealth effect, which I think is something we haven't talked a lot about recently. The stock market keeps going down. What is the wealth effect? Do people stop spending? There's already some early evidence that is going to be happening. So we've got a lot to discuss this Monday morning. We'll probably all really talk about the golf, but we'll talk about what else is going on as well. Jordan Rochester from Mizuho is going to be joining us, FIC Head of Strategy. Kevin Gordon, Charles Schwab, Senior Investment Strategist. Nouriel Roubini is going to be here as well, Roubini Macro Associates. And Diana Choileva, Inodo Economics Chief Economist, is going to be joining us to give us a take on what is happening in China. What is China up to? How prepared is it? What is going on? We will ask her a little bit later.
Plenty of great conversations coming up, plenty of data and plenty of earnings throughout the week as well. Something we haven't talked about this morning is, of course, the slew of numbers we got out of JP Morgan, Wells Fargo on Friday. Goldman Sachs is going to be reporting today, plus a slew of other bank earnings throughout the week as well. We've got UK employment on Tuesday as well. And then it kind of all goes down to monetary policy later in the week. Chair Powell, what is he going to be making all of this? U.S. retail sales will show up, perhaps reflecting some of that kind of worries in the consumer confidence data. And then the ECB rate decision. But I think the highlight really is that we get Friday off. We get a little bit of a break.
It's a short day. It's a short week. You've got another short week coming up as well. I wonder how you manage risk this week. Just because we've got 4 days.
Yeah.
Who knows what's going to happen over 4 days? I would argue you put all the news into those 4 days. We can go through the full arc of everything that we need to know and hopefully come back on Tuesday morning being fully informed with an accurate picture of what is going to happen. That ain't going to happen. I know that's not going to happen, but it'd be nice.
In terms of the data, though, I'm curious, is it what we're going to wait, of course, wait for Chair Powell and what he has to say as well. But to me, I think the bank earnings are really crucial there. What Jamie Dimon said last week, he's ringing the alarm. He's saying, look, recession odds are there. Chair Powell is fully capable of stepping in. But he went from an uber consumer bull of American resilience and consumer exceptionalism to saying, actually, guys, we have a problem.
He has been talking about the hurricane for a while, though. He has been talking about the storm gathering. It's not all been plain sailing in Jamie's view as to what is going on in the world for quite some time. Obviously, there's turbocharges, all of that. So what else you need to know this Monday morning? Iran has said talks with the United States over the weekend were, quote, constructive. Saturday's meeting was the first top-level meeting between Washington and Tehran since 2022 and marks a renewed effort to resolve a standoff over Iran's nuclear program. President Trump has said repeatedly he wants a deal or he will resort to military action. The next meeting is now scheduled for April the 19th. UK officials are rushing to secure raw materials needed to keep Britain's last primary steel manufacturer running. The government passed an emergency bill on Saturday to take control of British Steel after talks with its Chinese owner broke down. The UK Business Secretary, Jonathan Reynolds, spoke about the takeover at an emergency session of the House of Commons.
Since taking office, this government has been negotiating in good faith with British Steel's owners, Xingye. We have worked tirelessly to find a way forward, making a generous offer of support to British Steel that included sensible, common-sense conditions to protect the workforce, to protect taxpayers' money, and create a commercially viable company for the future.
From one extreme to the other, tech giant Meta and America's Federal Trade Commission will meet in court today in a high-stakes case that could result in the social media giant being forced to divest Instagram and WhatsApp. The FTC is accusing Meta of buying the two businesses to stifle competition. It's a case that started in the first Trump presidency and will be a big test of his new administration's willingness to take on big tech. The sense seems to be that the FTC and its lawyers face an uphill battle here, that it is going to be difficult to achieve that divestment story. But nevertheless, it just shines a light, I think, on the Trump administration and what its policy towards big tech is going to be. Because at the moment, it feels like it's all over the place. We come back to what is happening with Apple. We look at this case here. The expectation was that Zuckerberg would have an in with this administration, that Tim Cook would have an in with this administration. It's turning out to be a bumpier ride than many, I suspect, in Silicon Valley would have hoped for.
Well, we were waiting for the deregulation that he was screaming for on the campaign trail, and that meant for a lot of people more M&A activity. But take a look at what's happening to M&A activity right now anyways. They're looking at the volatility in these public markets. They're saying, let's give it a second. Facebook, Meta, Apple, Amazon, all these big tech names aren't able to position and grow that quickly. They do it through acquisition. So this is going to be a really crucial one.
Yeah, they did it through acquisition. Certainly in the early days, that was the idea. This is an antitrust case. It'd be interesting to see how. So I think Meta's idea will be to present this as the consumer is benefiting here.
Yeah.
i.e., these businesses are better within our fold than they are as individual standalone entities. And as a result, the consumer has benefited from that. So it's going to be interesting to see the two different ways of approaching this from Meta's side and also from the FTC side. Yeah. We'll watch very carefully, I think.
Well, and is the FTC just going to be sending a different message than what Meta is dealing with right here in Europe with the European Commission. That's going to be certainly something we keep a very, very close eye on. In addition to what's coming up on the show, we were talking at the very start about this kind of change or gear shift around some of the chip stories and the technology. Infineon up sharply on trade day. We're going to see what the ripple effects of that are. Plus, JP Morgan CEO Jamie Dimon warning of stormy seas ahead amid Donald Trump's trade war. We're going to dive into the details and some more of the bank commentary throughout the week. But up next, we're going to dive more into the markets. Nicholas Brooks from ICG will be joining the program. If you have any questions of your own for us or for our guests, get involved in the conversation. IB plus BBTV Go is the function on your terminal. This is Bloomberg.
From our perspective, we're seeing a complete deleveraging of positions, and that's what's been driving it. So whether it's been swap spread trades, whether it's been the Treasury basis, whether it's been investors who sold Germany and bought the U.S., all those things have begun to unwind, and it's put a lot of downward pressure on Treasury prices.
Well, Michael, global head of fixed income at JP Morgan Asset Management, speaking to the surveillance crew yesterday as we came into this new week. I think the Treasury curve has been steepening for 9 straight weeks now. Valerie's here with the details.
Yeah, steepening for 9 straight weeks, Guy, and every day yesterday, last week, the 10-year yield headed higher. 60 basis point rise in the 10-year yield last week, but it looks like there is a bit of calm when it comes to the Treasury market. We are lower all across the curve. That 10-year yield lower by nearly 3 basis points. So while there is some calm in the Treasury market, though, there is still other trades that are extending. The main one being dollar weakness. We're seeing the dollar headed lower this morning, hitting fresh lows for the year, trading at a lows not seen since last October. The main outperformer on the back of this is the Japanese yen. And Guy, I think this tells us that those repatriation flows out of dollars into home currencies might still be continuing. The yen is particularly vulnerable to that kind of repatriation flows as a large chunk of Japanese investments are held abroad. So to keep an eye on dollar yen and also on the euro for any hints of those repatriation flows continuing. Guy, I want to end with one chart that I found very shocking. 5 years ago on the onset of COVID, if you plowed your money into gold instead of the S&P 500, you would have now returned the same. The recent decline in the equity market compared to the recent new record after record for the yellow metal has now shown over the last 5 years they're neck and neck on returns. It's
amazing, isn't it? Kind of one equity is, in theory, very risky. Gold, in theory, isn't. I think it's interesting to see how divergent this market is. Valerie, thank you very much indeed. Let's get more on these markets. Nicholas Brooks, Head of Economic Investment Research at ICG, joining us around the table. Good morning. What's going on with the U.S. Treasury market right now?
Yeah, I think we're seeing a realignment from investors. We've had 2 years where everyone has viewed the U.S. as sort of in an exceptional position of 2 to 3% economic growth. Inflation coming down at a steady pace, people feeling very comfortable with the outlook, money going into the S&P 500. We're now seeing a complete shift because there's a huge amount of uncertainty, of course, because of these tariff policies. The concern is that the U.S. growth, the U.S. economy is going to slow potentially quite sharply. So the questions about, how quickly the Fed might have to cut. And then on top of that, we have the Treasury market issue of what already has been a large amount of supply coming into the market from the U.S. Treasury. And the concerns are if we see a slowdown in growth, fiscal deficit widens even further, and we're going to see an even bigger supply coming into the market, hence yields start to rise.
So we've got this kind of multiple set of factors coming into the Treasury market. Just want to come back to Valerie's last chart on gold.
Yeah.
Are Treasuries safe havens? Because in theory, what should happen at this point is that equities start to come under pressure, Treasuries catch a bit. But that's not happening. Gold is catching a bit, Treasuries aren't.
Yep.
Again, what does that tell you about investor sentiment and what is going on out there?
Yeah. No, I think, and what's interesting is gold has been rallying for quite some time now. I think structurally the U.S. has been running big fiscal deficits under Biden, and now it appears we're going to continue to see that under Trump. And the concern at that point is the dollar a safe haven in the medium to long term? So people are diversifying. So I don't think people are wholesale selling dollars and saying, it's the end for the U.S. But I think long-term investors are saying, maybe we need a bit more euro, maybe we need a bit more gold, maybe we need a bit more Swedish krona. Yeah. But what we need to do is diversify ourselves away from the U.S. dollar.
There's a question here, in addition to a potential stop in business sentiment or business investment, a potential stop in consumer investment as well, that the lack of spending from the government is ultimately what's going to be the straw that breaks the camel's back, and that we're talking about these massive federal layoffs, we're talking about defense contracts that are kind of going away and dissipating as well. To what extent is that the underpriced risk in this market?
No, I think that's right. And I think, as you probably spoke about on Friday, the data coming out of the U.S. on the consumer sentiment is quite worrying. We've had 3 consecutive months of sharp falls. And again, inflation expectations rising, and that puts some constraint on the Fed to react to that. And then on top of that, we're getting cuts in government spending coming through. So I think the combination of these factors, plus actually what you mentioned earlier on, is the wealth effect. Yeah. The stock market's falling. People are still looking in the U.S. at pretty high mortgage costs. So are we going to see a further, down leg in private consumption? So I think we're in a pretty difficult place right now in the U.S.
You mentioned that kind of digestibility being an issue when it comes to extra issuance from the Treasury market as well. Is there an argument here that there's too much liquidity in the system, not just in the Treasury market, but in the equity market as well, that would almost dissuade some sort of Powell put?
Interesting. Yeah, to be honest, I think where the Powell put comes more into question is the inflation expectations. Looking at those long-term inflation expectations rising so substantially, I think is very worrying to the Fed and to any central bank, because, of course, what they worry about is that self-reinforcing cycle. And it's the worst-case scenario, the so-called stagflation scenario, where you have growth slowing and a central bank in a position where they can't really cut aggressively to shore things up.
So what's the advice right now? Very little clarity, a lot of opacity, a very bumpy policy path ahead. Yeah. What do you do as an investor right now? You talked about diversification a little bit earlier on. Is that just pot luck? Because in some ways, some of these countries are being affected by Trump policy. You get a reaction in the other country as well. I diversify, but I don't know which bits of my portfolio are going to be affected by the trade war. Yeah. So what do I do? Just to go as broad as I can?
I think what a lot of people are doing, and I think it's rational, and often this is not a rational thing to do, are moving to cash and moving to the sidelines or moving into gold. If you're in liquid markets, if you're in more private markets and you're looking long-term investor, well, you might be looking at this volatility as creating opportunity to find some good value for a long-term investment. So, so for me, it would be cash, gold, private markets with a long-term time horizon.
Do I own cash because I think better opportunities are coming, or do I own cash because I'm seeking safety?
I would say you'd be holding cash just to watch and see how things pan out. And I think ultimately we will have a better buying opportunity.
Okay.
So I think it's just waiting for that time, and no one knows what it is because no one knows what those tariff policies are going to look like tomorrow, next week, or a month from now.
Doesn't holding cash, though, make you more susceptible to any sort of inflationary shock?
Good point. Well, I guess what I would say to that is the idea would be that you wouldn't be in cash for too long, you would hope. But wait until we see how these policies play out, because they seem to be changing pretty much every day and every week. And until that settles down, I think it makes more sense to sit on the sidelines and watch.
You're still getting 4% at the front end of the curve.
Sure. For how long?
I know, but sure. But the Fed's not cutting at the moment. So let's assume that you keep 4%. You're basically matching inflation, aren't you?
I guess so. Sure. Until it flips in like 3 days, right? Isn't that the concern of this volatility? You can't actually bank on that 4%. It is quite literally picking your moments. Is what
you can't bank on anything right now.
Right.
I guess that's the challenge.
And that's the challenge. And I would say that's why sitting in cash, no one wants to do that for too long. Yeah. But we are in a period of massive flux right now, and one would hope it will start to settle down in the next few months.
Gold doesn't deliver any yield.
Yep. Yeah. Well, but maybe the S&P 500 does. Who knows? Nicholas Brooks, head of economic investment research at ICG, joining us around the table this morning. We're going to continue the markets conversation and how you digest these markets, how you digest this news flow. That conversation next. This is Bloomberg.
Monday the 14th, good morning. 30 minutes until the start of equity trading here in Europe. Bonds have just started trading. We'll get to those in just a second. This is what futures look like. Heavily influenced this morning, I suspect, by tech. You're going to see some of the big tech names out of Europe. Infineon, maybe one of those names, bouncing quite strongly. This on the back of the carve out for US tech, which apparently is temporary. Who knows what the ultimate tariffs will ultimately be? We'll wait and see at some point this week, maybe. Could be today. Who knows? Anyway, let's talk about what's happening in the bond market, which is actually probably a little bit more interesting right now. You have German 10-years OATs moving a little bit. There's a bid back there. What you do have is a fairly decent-sized move in BTPs. Italy's rating was upgraded by S&P Global Ratings Friday afternoon. That is now being priced in to the BTP market this morning. So just keep an eye on what is happening there. Inflation, obviously a factor in all of this as we work our way towards the ECB meeting on Thursday, but also a factor in the United States right now. So we try and watch which piece of data we should be focusing on when it comes to the inflation narrative. Kriti's all over that story.
Well, Guy, we keep using the R word, recession. What does that look like? How do we know when we're in one as opposed to just looking at it in hindsight? And I think the important piece here, at least for me, has been what is the consumer doing at the end of the day? Or is the consumer responding to some sort of bracing for impact from businesses? Nevertheless, I'm looking at a set of data that we got on Friday coming out of UMich. Now, the top panel here is going to be inflation expectations on a one-year basis. So just how expensive are things going to get in 12 months' time? The median estimate on that. The bottom panel, by the way, is the consumer sentiment index. And I like to look at both of them because every time they don't always correlate. They don't always show you the same kind of messaging and that higher inflation equals lower consumer sentiment. But that's the moment we're in right now. And that's what this panel really shows. Inflation expectations hitting the highest going back to the 80s. I'll show you that in just a moment. Just as consumer sentiment takes a beating as well. A lot of this tariff narrative, the idea that things are about to get more expensive, already worrying consumers in the United States and having ripple effects around the world. But when we have this kind of divergence in the data, we tend to see it kind of align with some of the recessions. I'm going to take you back and give you a little bit of a history lesson here. The last time we saw this jump in both sets of data in opposite directions was in 2022. Now, of course, we didn't hit a recession at that point, but we did see this question of inflation expectations. We did see the Fed hiking very, very aggressively and met, by the way, by a massive stock market decline. So that was 2022. You have to go back to 2008 to see the previous example of both of these data sets. Going back even further, because we feel like we need to look at historical parallels, we go back to the 1990s, the early 1990s. I had to Google this one, Guy. Maybe you'll remember it. But this was important because this had a lot to do with this thing called the December freeze. Not a recession, but a really, very cold ice storm, I'm told, that actually messed with the data a little bit. But then right back, the further example is Volcker-era economics. Under Jimmy Carter, this idea of inflation expectations got really high. A recession was basically manufactured by the Federal Reserve. Is that the moment we're in? I don't know. But the data suggests that we're in an era of worry.
What's really interesting here is that actually in so many ways the UMich data is or tends to be heavily influenced by what happens with gasoline prices. Generally, they are the kind of North Star for the UMich data when Joanna Shu pulls those numbers together. What I think, Kriti, is interesting is that that's not turning out to be the case. Gas prices have been coming down, but the consumer is still seeing more inflation coming through. And I think that will be the worry, that this is clearly something out of the ordinary, as you say, to see what is happening here. And the consumer's also been bitten a lot by inflation recently and is really wary of it. So it'd be interesting again to see what happens on spending. Is this ultimately the straw that breaks the camel's back, to your point, that drags the consumer down? Or is it just a broader wealth effect that comes out of the stock market? Or is it just a combination of all of it?
I love that you brought up oil because I feel like the conversation in 2022 and specifically in 2021 as well as when we were talking about these inflation increases, oil was part of the conversation, but you heard so many times that chips are the new oil in terms of the commodity increase. So it's interesting to me that even with lower oil prices, a lot of American consumers, I would argue global consumers, are looking at the prices of washing machines, of iPhones, of EVs, of the things that require more of that technology space and ultimately that dependency on China that's freaking everyone out. But the idea that maybe iPhone prices is the bigger scare factor than oil prices tells you a lot about the era we're in.
Yeah. I think somebody worked out last week that it would cost £3,500 for an iPhone if it was manufactured in the United States.
Yeah.
Is that the direction we're ultimately going in? Because that's going to become quite prohibitive, I suspect, for a lot of people. Is this something that you have to have, or is this something that is just nice to have? Do you have to have the latest version? I don't know.
Maybe we all switch to Androids and Samsungs.
I don't know. I'm an Android user. Phones don't tend to cost quite as much. Certainly the ones I buy. Anyway, let's talk about what is happening with these markets right now. Let's figure it out. Our executive editor for Asia Markets, Paul Dobson, joins us now. Paul, in terms of just setting us up for the week, we're going into a week where it looks like the dollar is starting on the back foot. Is that a trend that is likely to continue and be maintained?
That's certainly the risk scenario, Guy. I think that's what people are worried about. And that narrative does seem to be gaining traction as well. The idea that people are moving their cash sequentially out of US assets, both on the equity side and on the bond side, in favor of overseas assets. We saw a lot of that, obviously, last week with all of the volatility. Now, in the Asia session, the dollar did start particularly weak. It's actually recovered some of those losses. You know, one thing we don't really know for sure, but one thing that's going to determine it is how far the Trump administration is still going to go with the tariffs. If there are more signs of an easing of those tariffs, then that may play into a more favourable dollar perspective, particularly if there's less confrontational approach. On the other hand, you know, if people are genuinely losing trust in the US and the US economy and US assets as a whole, then there could be a long way further to go because the dollar is overvalued on most measures of relative value for currencies.
Paul, what do dollar bulls need to hear from Chair Powell to reinstate some confidence?
I don't know if it's Powell who will be the one that will give them confidence. It's more all about the president, right, Kriti? I think that one thing that we did get a little bit of positivity in U.S. markets on Friday was from the fact that one of the Fed speakers, Collins, was talking about the idea that if there's market dislocations, then don't worry, the Fed's got your back. But they would need to be pretty extreme because we've already had some pretty big market dislocations. If you look at swap spreads, for example, if you look at bid-offer spreads at the back end of the U.S. yield curve, you know, there has been some troubling signs already, and we haven't seen any action so far from the central bank. I think, you know, if the central bank does say that it's going to do something, and that could mean stepping up cuts in interest rates, and actually that could still play dollar negatively rather than positively because of those relative spreads. And if people are taking their cue more from short-term yields than from long-term yields in the US, then that may still not be very supportive for the dollar.
Let's talk about gold. Gold catching yet another bid. Is gold the new treasury? There's a lot of debate about this over the weekend in what I was reading. Can gold replace treasuries as a safe haven asset? It's a much smaller market. You're going to see, therefore, the market moving much more aggressively in theory. Can it really serve the same purpose given the scale of the two markets?
I mean, the one thing that gold has going for it is it's physical, right, Guy? You actually have gold in your hands or in your reserves if you're buying it, as opposed to treasuries. So on the flip side, treasuries pay you a coupon. They give you an asset that you can use as collateral in trades elsewhere around the world as well. So they're useful in terms of greasing the global economy as well as a store of value. On the other hand, if you just want to stay away from the dollar, and a lot of people are talking about that being a possibility, then you need something else. Gold, European bonds, Japanese government bonds, they're where people are looking.
Paul Dobson, Bloomberg executive editor for Asia Markets, walking us through all the assets, maybe an alternative to the dollar at the moment. It's fascinating the ripple effects that this dollar weakness is and is not having, and that it's having a positive effect on the likes of Europe. But I'm not seeing the bid into commodities the way, besides gold, but into commodities that a weaker dollar would traditionally bring.
There's a couple of things I just want to point out. One of which is the euro is now above 114, which I think is worth paying attention to. So that is getting some traction. The yen is now north of 142, so we're keeping an eye on what is happening there. The Japanese 30-year is up 16 basis points. So you're seeing some quite... This is a move that's picking up pace over the last kind of half an hour or so as European traders start to get their feet around the desk, under the desks. So just keep an eye on what is happening there. That 30-year move in Japan is a fairly big one. We're now north of 114, as I say, on euro dollar. So I think this morning is setting up, just demonstrating once again the market nerves around what is happening here. The US 5-year down by 4.8 basis points. So you are seeing some positive news, you could argue, in the Treasury curve, but the move in Japanese 30 years is worth noting.
And we should mention that as you talk about the dollar move, a lot of that getting amplified in the Treasury. You mentioned Treasuries as well, but 444 on the 10-year, now down 4 basis points. And cable as well, almost at a 132 handle. So seeing some gigantic moves in the UK as well. So where do you hide out in this market? This morning, some of the optimism certainly in the European currencies, certainly in some of the semiconductor stocks as well. Is the reprieve over the weekend actually positive news? We're going to dive into the details in our stocks to watch next. This is Bloomberg.
16 minutes till cash opens this Monday morning for equities. There's a lot going on out there. Japanese 10s are fairly stable. Japanese 30s really are. The yen is on the move. Euro dollar's trading north of 114. The dollar's definitely on the back foot. Valerie's here and she's worried about deficits. So let's start there.
Guy, I think one thing that was maybe like shoved to the side alongside all this tariff chaos yesterday was the March figures for the U.S. federal budget deficit. And they came in way above expectations. And the thing is, if you annualize just the last 6 months of government spending, we're nearing a 9% deficit as a percent of GDP, which is a shocking
Everybody thought it was about
figure.
6, didn't we?
Exactly. And we thought, with the Trump administration, maybe spending will be pulled back. And it's seeming like we're getting the exact opposite. There's a lot of momentum behind federal spending at the moment. We're looking at a 7% GDP if you don't take into account last week's figures. If you do, it's a lot higher. And I think what we need to there was a lot of noise last week. Let's just put it that way. But if you just took the signal that risks of an economic slowdown went up last week in the U.S., and we had that happen alongside Treasury yields rising. I think for us that is showing us that the U.S. Treasuries are trading purely off of supply and demand, purely off of deficit concerns. If we head into a slowdown with an already bloated budget deficit, people are more concerned about the oncoming Treasury supply than they are about rallying because of low growth and perhaps low inflation. So I think to me that was particularly telling. I know we're seeing a reprieve today, but I think we'll be chewing over what exactly the implications were for this bout higher in Treasury yields last week.
So what comes next? Just walk me through the trade that happens next. Does the curve just keep steepening?
The U.S. has to stabilize its debt to GDP. And if you're doing that with alongside a GDP being smaller, it means you really have to pull back on spending, which is going to be quite painful for the U.S. economy, which is going to lower GDP even more. So you're getting yourself into this very nasty cycle where really the only way forward is more and more Treasury issuance. And you combine that with the fact that a lower trade deficit means you're going to have less international counterparts recycling those dollars into treasuries. It just does not pose a very pretty picture when it comes to the long-term outlook for treasury yields.
Okay. Let's take a look at what is happening with other sort of factors around this story. The dollar. Valerie, thank you very much indeed. Dollar yen under a little bit of pressure this morning. I think you've got euro dollar at 114. The dollar's under pressure again. Joining us to discuss all of this, Jordan Rochester, EMEA head of fixed strategy at Mizuho.
Good morning. Hi.
Well done for Jordan's had a ride in this morning.
English trains let me down, let's just say.
English trains, British trains, British Rail. Where does the buck stop?
I'm surprised that the dollar's on the back foot this morning. Donald Trump's sort of reciprocal tariff watering down over the weekend. You'd expect some signs of the dollar no longer having its peso problem. That's what it's going through. But we're carrying on. And this is alarm bells, I think, for the U.S. Treasury Secretary Scott Bessent. He's now seeing a watering down of tariffs, but still dollar weakness and U.S. rates selling off still. It's a horrible, toxic combination. So we're looking for euro now to be in a 115 to 120 range. I said that when we were at 112. That was just a few hours ago, It feels like. We're now at 114. So the pace of the move is faster than I thought it would be, for sure.
Is the dollar responding to the Treasury curve, or is it responding to the perhaps kind of flight from American credibility? What is that move responding to?
The most difficult part of foreign exchange is it's not really an asset class, it's a flow of money. So you have to use other asset classes to figure out what's going to drive the flow of money cross-border. Interest rates typically are the ones that we follow. We adjust it for inflation during a sort of peso crisis, is what we're kind of going through. And that was working to begin with, and then it stopped working last week. So even when you adjust for inflation differentials, there's clearly dollar selling and US Treasury selling going on. The only yardstick I can use is oil. So oil had such a large shock to its system, a huge hit to growth, and you've had a huge fall in oil. That explains a large part of the dollar fall so far. It's a terms of trade shock. The US is a net exporter. So if you plot oil prices versus the dollar, the correlation has picked up in the past few weeks. And it says that we've probably got another 2 to 3% before this sell-off is done in the fast sort of short term. But we are talking a long-term structural shift out of US assets by foreigners, and that's going to lead to a lower dollar valuation where it's been consistently expensive for the past 10 years.
Expand on the from foreigners piece of it. There's a lot of speculation here that some of the big buyers of American assets, treasuries and the dollar, like China, are the ones that are selling, that are ones that are exacerbating this move. Are you seeing that in the data?
So annoyingly, we don't get the data quickly enough. The data's always lagged. But what you can clearly say from a rational point of view is that you've got the extreme tariffs on China and also future reciprocal tariffs that will be extreme on other Asian central banks. And they've got to defend their currencies. You've seen a much slower pace of sell-off in the renminbi than you expect, given the size of the shock to their system. So there's clearly some sort of smoothing going on in the FX market. And to do that, a central bank has to sell the US Treasuries and others to fund that FX intervention.
So the Chinese are selling, yeah?
We can only speculate. But we'll find out in the data soon.
What's your degree of confidence?
Pretty high.
OK. Where does that leave the ECB?
Now, the ECB is pretty easy for me. I actually thought the hawks should really sit down, stay quiet. The dubs will own the room. You've got a terms of trade shock, you've got a growth shock, and you've got inflation lower. It's a triple whammy. Combine that with tighter financial conditions. Oil lower, it's going to send their inflation forecast dropping very sharply. Natural gas is 30–40% off the highs back at the start of this year. It's just really hard for me to see hawks dominating. Well, look, the ECB, we think we're going to cut into loose territory. A lot of the debate is quite exhausting. It's about neutral. Yeah, Neutral's so around 2 in most people's measure. And I'm talking 1.5, I think, by September or later. Probably by the end of this year at least, we're talking sub 2 down to 1.5 and potentially even lower.
What does that mean for euro dollar here? We're looking at 114. Give us a ceiling, give us a floor.
If I was to base it on interest rate differentials, I'd be selling euro dollar, but that's clearly not what's going on. So for the time being, I think we're going to 115, 120, that sort of range. It is the 2017 playbook all over again. And there's some optimism. I'll give you some good news, which is essentially all this pain now is driving the EU to act more as a unit. It's bringing leaders together. I never expected after the German elections to get fiscal stimulus so quickly. So we're talking joint EU issuance being a possibility, and more importantly, reform. Even the EU are talking about reforming GDPR. I can't wait to see that happen. I'd love to see every single website no longer ask me, do you want to have cookies? That would be a fantastic thing for a minor point. But I think you're going to see banking union come together, you're going to see joint issuance and more of a relaxing of state aid rules. So the second half of this year, it's all grim right now in terms of trade tariffs, but all this action should bring the leaders into unity, and we could see much higher growth potential.
Is the bullishness around Europe and this optimism that Europe is basically going to get its act together overdone? And I put this in the context of this massive kind of German yield move that we've been seeing as well, and the fact that we're still dealing with deficits and economic constraints and public kind of utilities that are collapsing in Europe. And the only bright spot seems to be that Germany has room to spend. Is that too much on Germany?
The human mind tends to overestimate events in the short term, but underestimate them in the long term. This German news story on infrastructure and defence, it's massive in the long term. We've got the frugal four no longer having its largest partner being frugal. However, you're right, in terms of timing, the issuance really won't come until Q4 at the earliest. So we're not going to see a big impact to growth from infrastructure and defence, but we're seeing sentiment change. And that sentiment shift has helped bring forward some of the growth that you get from that issuance. But you're right, it could turn out to be that we're sat here waiting for good data out of Europe, but we continue to march down to a slowdown.
Also thinking long term, Besant is implying at the moment that Europe is going to have to pick sides between China and the United States. If that is the case, how does that affect the European economy and its outlook and what the ECB ultimately has to do? At the moment, it's trying to play both sides. Europe is talking to China, talking to the United States, but Besant is talking about Kennan-like containment on an economic level of China.
There's a growth shock and an inflation shock. I think of the two, the ECB is so focused on inflation, it would be inflationary. If you start raising tariffs on China on the EU side, if you're worried about product dumping, which they are, then you're going to see goods price inflation not go into the sort of disinflation, deflationary story I expect. Essentially, all these lovely
does that get them into,
BYDs are not rolling out in Europe as quickly.
Does that get them to 1.5, though? If we've got an inflation story, why we're getting to 1.5 on?
If they raise tariffs on the EU, that will definitely give the hawks some room in the ECB meetings, and therefore the 1.5 is slightly less likely. But the growth story, I think, will dominate eventually.
Okay.
All right, Jordan Rochester, EMEA's head of fixed strategy over at Mizuho, joining us around the table to dive through some of these fund flows. Let's go from the currency picture to the stocks picture. We are 8 minutes away from the open. Joe Easton with our stocks to watch. Joe.
Morning, Kriti. So we have seen a move higher in the tech stocks overnight in Asia following news of these exemptions on tariffs for some electronics goods, although it does seem to be watered down slightly since the initial report broke on Saturday. But here's the stocks in Hong Kong. We see them gaining around 2%, and potentially we're going to see moves higher today in the European chip makers. We're already seeing some moves in the likes of Infineon on the Tradegate exchange. Big losses for these stocks year to date, of course, so potentially a bit of upside. And then just to focus on ASML, because numbers coming out from them on Wednesday as well. We can see last year at the peak that stock traded around €1,000 a piece. We're now down below 600, potentially, as I say, upside for that one. Then in terms of autos, we've seen a move higher as well in the Asia-listed automakers overnight. This after a report saying that potentially the EU and China are working towards minimum pricing rather than tariffs on EVs sold in Europe. So it's kind of unclear how this would affect the companies in Europe, but they have been hit by competition from EVs in China, and we can see that on the screen here. So potentially we might see a little bit of a read-through into that sector as well. Then on the M&A front, a takeover of Salzgitter, the German steelmaker, looks to have fallen apart. The company and a group of investors were unable to agree on a valuation, so that deal now no longer going to take place. Keep an eye on that one in Germany.
Joe, great stuff. Thank you very much indeed, Joe. With some of the single stocks that we're going to be watching, tech is going to be a big theme this morning. Of course, it's going to be a big theme this morning. We're going to be watching that, Kriti, in the wake of what we got from Donald Trump over the weekend. Tariffs are off, tariffs are on. They'll come back soon. We're not entirely sure.
There's a lot of sectoral stories to be keeping an eye on for sure, but there's also this currency impact. You mentioned it there. We're looking at 114 on euro dollar, 131 on cable, just shy of 132. What's the ripple effect on those indices? That coming up next. This is Bloomberg.
Monday the 14th. How you doing? We're already starting to see some volatility. I just warn you because it's going to be a bumpy week, I suspect. We're already seeing it at the yen this morning. What is happening with JGBs? Euro dollars north of 114. What does this all mean for equities? Well, actually, in some ways, I think equities made trade this morning off what we got over the weekend when it came to the tech tariff story. That is likely to be the big driver. European equities went out Friday kind of here. US equities rallied a little bit. There's a little bit, therefore, of a tailwind coming in to European futures this morning. Let me show you kind of where we are. We are positive, but I suspect you are going to see maybe the names like Infineon, ASML, these kinds of names doing well off that tech story that we saw coming out late Friday and then through the weekend. The arc of kind of understanding, I think we call it, or lack of understanding. Where are we Monday morning? I think with a positive picture, but an uncertain picture. So Euro Stoxx futures up by 2.48, FTSE's up by 1.8, DAX futures up by 2.5% this morning. So you're going to get quite the bump, Kriti.
Well, speaking of that bump, I feel like a lot of it's going to be coming, as you mentioned, from the chip sector as well. We're already getting indications of that in the pre-market when it comes to the likes of Infineon. Tradegate talking about a 5% increase on some of that pre-market pricing. We'll see how that shakes out in just a moment. European banks are something I want to put on everyone's radar, though, this morning, because, of course, the Italian government has now authorized Monte Paschi's bid for Mediobanca. So the consolidation story is still rolling in the background. BNP also reacting to an ECB opinion when it comes to AXA. They're saying that this ECB opinion, if it comes to fruition, could talk about a 35 basis point impact on their capital leverage requirement. So really keep an eye on that one as well. And pharma stocks, again, rolling in the background, getting several regulatory approvals for the likes of Sanofi and Roche. That might shake this market up, Guy.
Yeah, are you going to get Pharma sectoral tariffs, tech sectoral tariffs at the same time. I don't know. Anyway, we'll watch this week. It's going to be a bumpy one. Let's start off with the Monday session. Remember, it's a short week as well. We are expecting a move to the upside, fairly dramatic move to the upside for European equities this morning. Does London get left behind because it doesn't have much tech? We'll wait and see. Certainly the DAX, I suspect, with names like Infineon and SAP could do well in this morning's trade. The Stock 600 is already up by 0.9% and climbing. The FTSE's up. The FTSE with little tech is climbing this morning, and it's going to be interesting to see what the prime drivers of that are within the mix there. But the IBEX up by 1.75%. We'll wait for the CAC. Remember, LVMH is going to report sales and revenue at around 4:40 London time. There's a call at 5 p.m. London time. You're going to watch that one very carefully, I suspect, out of today into tomorrow. But the CAC this morning up by 1.9%, outperforming the Stock 600, which is up by 1.4%. The IBEX is up nearly 2%. Let's see how high the DAX goes when it gets going in a few minutes' time. Kriti.
The gains are broad, Guy. You're seeing this across the FTSE 100, across the Stock 600 as well. Let's start with the FTSE 100, though, because I think this is interesting. You talk about how it's kind of defying a little bit of gravity here, despite the fact, I should say, you are seeing less tech exposure. Oil markets driving this index. I think it's interesting. You're seeing the likes of Shell, BP, Glencore. A lot of the commodity names are your outperformers this morning, despite the fact that Brent crude is actually flat on the session. I'm looking at a 64 handle there. So interesting to see where it's getting that direction. On the Stock 600, though, you called it. It is tech all the way. ASML is your biggest points contributor to the upside, alongside a little bit of pharma, as we were expecting. So Novo Nordisk, Novartis, a little bit of Roche in there as well. So tech and pharma leading the gains. But again, very, very few stocks in the red this morning. Yeah, you got down 17 stocks, up 506 stocks. So there's obviously a big move to the upside. And as you say, it is reasonably broad. Be interesting to see how long this tech story lasts, though. Do you get the positive vibe from the fact that they get rolled back, or do you worry more about the fact they had to be rolled back because that exposes just how deep US tech is into China, and B, the fact that sectoral tariffs are coming? So how long does this tech bump last this week? I think this morning, Freudian slip. Fair enough. We'll forgive you on that one. I think we're all still waking up. But I think it's crucial that if you talk about this from a fundamental perspective, because, look, there's a very real chance that these tech stocks and these that are rallying today are going to sell off big tomorrow as well. That's just a function of the volatility. The other piece of this is that maybe it is a good thing. I'm kind of putting my bull hat on there here. Maybe it is a good thing that any sort of tariffs that we do get aren't going to be the 145%. That is a very high number. So to beat that, it is. The barrier is high. The bar is high. I know, but the problem with that argument is that you assume the higher it goes, the worse it gets. There is a point at which you get to where it's just the damage has already been done. Yeah. And anything beyond that doesn't actually have that much of an effect. So I don't know where the numbers are, but say it's at 70%. So say they're brought in at 70%. Is there a difference between 70% and 145%? I don't know. Yeah. But there is a kind of 70% is still a bad number. Oh, absolutely. It's still a bad number. But I suppose for Europe, it's a good number if you're an ASML and you're making the equipment that makes the chips, because it's still going to be in demand, right? So from a fundamental perspective, there is this kind of divergence, I would say, from some of them. Maybe. I'm trying to be an optimist. You gotta give me a little credit here, Guy. You know how hard that is to be. On a Monday morning? On a Monday morning, and for me as well. I prefer the gloomy stuff is way more fun. We are waiting for the DAX, I should say. It's 8:03. I'm not seeing an early pricing on it just yet. But again, we are seeing some of the individual movers show up in the kind of Stock 600 pricing. I'm looking at early pricings of Infineon, which are already higher by about 4.3%. And I jinxed it. There it is. To the upside. So that's your outperformer this morning, right next to the CAC, by the way. So LVMH ahead of those earnings, also driving it. Let's see if this sticks and bring in a true expert. Kevin Gordon, senior investment strategist over at Charles Schwab, has made the trek from the United States and joins us around the table. What are you hearing from the clients you speak to in the States and globally? Because there's this narrative circulating that Europe is the safe haven now of the world in this kind of flight away from American assets. How much power does that argument have? Yeah, I mean, it works with a pretty long lag, especially because of our, U.S. investor base being so, biased towards the U.S., not only because it may be what they know, but also because of the dominance and the outperformance over such a long period of time. So we've certainly been, pounding the table, especially our international team, over almost the past calendar year, where you want to have more exposure, more diversification across
developed and to some extent emerging markets, but definitely have a bias more towards developed international. But it works with a pretty long lag. And even though you've gone through this pretty dramatic narrative shift over the past couple of weeks, I do think that, and you guys have been covering it really well, I do think that the decline in the dollar, to the extent that that continues and starts to show at least a little bit of a chipping or a fraying in this U.S. exceptionalism narrative that has been so strong for so long, if that continues, then you probably start to see at some point more of a bias towards, non-U.S. equities.
What does that do, though, in terms of kind of the reaction function of buying American equities? You would think that a cheaper dollar would make kind of the math around entering the U.S. market more attractive, not less.
Yeah, I think so. I mean, and again, this is I think a small mover or an elongated move, small right now, and it'll take probably time to play out. And the psychology of markets is such that, when we go through these massive events, especially, shocks that are quite literally man-made, supply shocks that are quite literally man-made, where we don't really have a history book to use. The bias is to try to say, okay, is this a zero-sum game? Is it dumping U.S. at the expense? Or is it going into international markets at the expense of U.S.? We don't really see it that way. We see a more level playing field where you should have exposure everywhere. But because their clients have been so underexposed to non-U.S. markets, whether it's in equities or fixed income, it's probably makes sense to have a gradual shift and a gradual change in your view over time.
How gradual? This is the question that I think a lot of people are asking themselves at the moment when they look at their portfolios.
Yeah.
Do I take a gradual approach, or are things moving too fast to be gradual?
No, I think gradual makes sense because, what gets lost, I think, a lot in the whole discussion around a global trade war, which this certainly is that there's virtually no pocket of the world that is not exposed. So It's not as if the U.S. is the only one that's going to hurt from this. Clearly, other parts of the world are at risk. I mean, if you're going through, and I think this is the difficulty in ultimately trying to get to the essence of what, at least from the standpoint of the United States, what the goal is of this, which none of us know really. In trying to figure that out, is this really a reshifting of the global trade order as the U.S. sees it or not? If it is, then I think that, we're probably dealing with much more existential issues. But again, that is not something that's going to be solved over time. So you're really looking at a shift in a freight liner. Certainly the U.S. is trying to do it. The administration is trying to do it, with like a speedboat. But it doesn't happen that way.
Are there going to be better opportunities to invest further down the road? Because this is so do I keep cash? Do I hold cash at the moment and wait for those opportunities?
Well, certainly the prospect of holding cash, at least in the near term, has continued to look attractive. I mean, especially if you think about the Fed staying in wait-and-see mode and really not trying to move dramatically one way or the other. I think probably for a longer period of time, cash is still relatively attractive because, if you think about this from the perspective of the Fed, wanting to move aggressively to the downside in terms of cutting rates is still really tough to do, especially because they have been relying, and we've all been relying, on relatively resilient, backward-looking, hard economic data, but that's all we can do. So if that's still the case and they don't see any major deterioration in the economy, especially the U.S. labor market, then there's probably not a bias to cut, and you probably have cash looking relatively attractive.
So what's the canary in the coal mine for you? You're talking about waiting for this data, at least from the Federal Reserve, but from your perspective, the UMISH data is brutal. The inflation expectations data is brutal. You are seeing maybe not widespread layoffs, but early signs of it, even pre this kind of tariff concern in some of the beige book as well. There are some minor cracks in this economy. At what point do you say, okay, this is the recession indicator?
I do think that all roads lead back to the labor market. And the big question now that we're still asking ourselves is there still this huge gap or a really long lead time between the soft data and the hard data where you're starting to see clearly a deterioration in the soft data? That is more, sort of crisis-like, instant supply shock-like.
Things like claims are still holding up.
Exactly. So there's not as much, when you start to look at the hard data, there's not as much of a feed-through. The filter effect is pretty strong still, where all of that confidence and sentiment still is rough and really depressed, really almost depression-like levels when you look at some of the UMISH data. A lot of it's at all-time lows. Expectations for income gains, inflation-adjusted income gains, household finances. I mean, you could go down the list. It is really at dour levels, but it's not yet filtering over to the labor market. And I wonder if it's going to take probably until, honestly, mid to late summer to see that actually filter over, if it does. If it doesn't, then you go through another, vibe session where the vibes looked really poor, but it didn't necessarily transfer over into the hard data. I think that we're at a different part of the cycle where the soft data probably does lead the hard data, because when you think about the last time we had this, 2021, 2022, yes, the soft data was deteriorating quite rapidly, but that was also happening as the U.S. labor market was rebounding rather strongly. We do not have the latter case this time.
Just thinking about pricing equities, do I need to assume higher treasuries yields? How do I think about equities going forward in a world that looks like we're going to have higher treasury yields, just from a kind of supply and demand, deficit, all these other arguments that are driving the treasury market?
Yeah.
How do I price equities right now, given that?
Well, in terms of yields, I think there's often a lot of focus, and rightly so, especially when you talk about the large cap, small cap debate on levels. The rate of change and the direction of yields tends to matter more in terms of the instant moves for stocks. So when we think about the inflation backdrop and the relationship between bond yields and stock prices, the fact that we have kind of slowly drifted over the past 4 years, into this negative territory where all else equal, which of course is not always the case, but all else equal, when bond yields are going up, it's putting downward pressure on stock prices and then vice versa. So if that continues, then you probably have a little bit more of a less friendly relationship. I wouldn't call it hostile like we saw from the 70s to the 90s, but you probably have a less friendly relationship between the two asset classes. In terms of pricing from a valuation standpoint, I think this is really interesting for this year because similar to 2020 and 21, when we saw a record number of companies, at least in the U.S., pull their guidance for earnings, valuation analysis was basically useless. I find that we're probably slipping into a similar environment today. Yeah, because, I mean, if you think about all of the weakness for equities, at least in the case of the United States, which is, what I cover and where I live, the compression has been all multiple driven. It's been all multiple contraction. So a lot of people will point to the E component and say, well, forward earnings are still going up, so it's fine. I mean, you can't really rely on that metric. So if forward earnings estimates are going to continue to go up, that's actually going to put, all else equal, upward pressure on multiples. But of course, we know that's not necessarily the case right now. So I think it makes, similar to 2020 and 21, again, it makes valuation analysis not very helpful, if probably, just not useless at this point.
Why is that not the case right now, though? And I give the example of last week we covered Delta suspending their guidance. We covered Walmart with their suspending their operating income guidance. It feels like we're there. Why do you say we're not? Well,
you haven't yet seen this, I think, overall avalanche. I mean, those have been early reports. And also, if you get down to the nitty-gritty, I'm not an analyst for individual stocks, but looking at some of the language from even both of those reports, you've got one company being on the discretionary side of things, the other company being on the staples side of things. With the staples company actually not issuing terrible guidance in terms of their, at least this year, but the other one really taking a step back and saying, well, because of all of the presumed weakness from an input cost side of things, but also from a consumer spending side of things, there's probably more, of
Are there
dark
stocks
cloud
you
hanging
will watch
over.
specifically? Like, is there anything coming up that you're going to... I know you're not a single stock guy, but what's the reporting season? What are you watching for?
Well, the banks have certainly... I mean, you made this point earlier. The banks, I think, have been helpful in terms of the state of things right now. Unfortunately, we don't really get a sense of that until real time. So I think by the summer, again, once we get a better read on if delinquency rates are going much higher or if the consumer really is stepping back in terms of spending, we'll have some data that lead us up until that point. But I am much more focused on the companies that are definitely more exposed, especially in all the tariff news over the weekend, the companies that are most exposed from an input side of things. Because so much of the focus for tariffs is often on the end final packaged consumer good. I think there's not enough focus on the inputs themselves because you could be exempt from tariffs, presumably, for a finished good, but not exempt from an input side of things. So if we're still going to rely on those in the U.S., then there's still a lot of exposure to that trade war from a multiple.
It takes a while to get through the supply chain to figure out exactly what is happening.
Absolutely.
Kevin, great to see you. Thanks for stopping by to see us on this side of the pond. Kevin Gordon, Senior Investment Strategist at Charles Schwab. Thank you very much indeed. Let's take a quick look at the Core 6 this morning, figure out what is happening there. Remember, we get LVMH sales and trading a little bit later on today. LVMH is up this morning. Unsurprisingly, it is some of the tech names that are doing better. So ASML is rising quite nicely. But actually, the standout story this morning is in the pharma space. Novo's up over 3%. Let's talk about some of the other single stock moves that we're watching. Joe has the details.
So as you mentioned, Guy, the tech stocks doing pretty well this morning. Pretty significant gains across the chip makers. We're seeing rises for ASML, as you mentioned there. Also BE Semi, Infineon, ST Micro moving as well. But it's not just the chip makers that are moving higher. We're also seeing some moves in some of the hardware makers as well. Logitech, remember, one of the firms absolutely hit by tariff worries. That one coming up 5%. And GN Store Nord more known for its hearing aids, but actually makes headphones as well that are used for personal devices. So we are seeing broad moves higher on hopes around these potential exemptions by Trump, although, of course, watered down very slightly since those initial headlines. Then we're seeing the car makers also having a pretty good day as well on news of the EU and China working towards some kind of agreement on the import of Chinese EVs into Europe, potentially looking at minimum pricing rather than tariffs as well. So that one seems to be a positive for the auto stocks. We're seeing the German names moving higher on that one. Then BNP Paribas. This is related to the company's purchase of an asset management business from AXA, and we had an ECB ruling or an ECB opinion on the asset implications of that. Potentially, it is going to mean they have a lot less capital on the books, but potentially a bit better than expected, according to analysts. So BNP, one of the best performing banks today, gaining 4%, a pretty decent move higher for that one. Then, in terms of Salzgitter, probably not as bad as the decline I had expected on that for Salzgitter, down 1.6% at the moment in Germany. Remember, a deal for the company, a takeover, actually falling apart according to a report out from our deals team over the weekend. And then one more to bring you was Wood Group. Take a look at this one. Was 25% gain at the open, now up 18%. The company getting a takeover bid from Sidara, the company that actually made a proposal around a year ago, then walked away because they couldn't agree on a final price. But they have got another bid coming up for the stock. That stock now trading at 29.50, but around a year ago it traded for 200 pence. It's absolutely cratered on worries about debt, but getting a bit of reprieve today. Wood Group down in the UK, small cap oil stocks gaining 18% in London at the moment.
Joe Easton from our equities team walking us through some of those early moves. We thank you so much. Coming up on the program, European chip stocks on the rise this morning, as Joe just mentioned. President Trump exempting certain electronics from tariffs, but saying more sectoral tariffs may be on the way. How do you digest it all? We're going to dive into the details next. This is Bloomberg.
Monday morning. Good morning. European stocks are higher. We've gapped first thing this morning. Tech is doing some of the heavy lifting. Pharma's doing some of the heavy lifting as well. But let's focus on what is happening with the technology story. European chip stocks are a big driver of the narrative this morning. We have an exclusion that comes through from the Trump administration late Friday on smartphones and other forms of tech as well. They've rode that back to a certain extent over the weekend as well, calling it temporary. But President Trump said there isn't a tariff exemption for certain electronics, promising that nobody is, quote, off the hook. Peter Elstrom has been tracking this story for us and is here to walk us through what we see next. Peter, I find it fascinating. TSMC overnight gapped higher first thing in Taiwan and then has faded. The fear has got to be, therefore, that actually the rates ultimately are still going to be fairly prohibitive for Chinese Asian tech going into the United States.
We had a lot of drama over the weekend, and I think investors are still trying to sort out exactly what it all means. As you mentioned, we got this exemption that was filed with the U.S. Customs and Border Agency over the weekend where smartphones and PCs, iPads are going to be exempted from this 125% tariff on China, which is a big deal. It looked like a big win for Apple and for NVIDIA and for some of the others also. Then first Howard Lutnick came out and said that this is only going to be a temporary reprieve. And then we got Trump saying nobody is off the hook. Everybody's going to have to face these tariffs. I think the bottom line is investors still have to find out more information. The Trump administration has talked about how this week they're going to start to explain what these sector tariffs on semiconductors are going to be. That's going to take a while, though. It's going to take some time to play out. It probably, though, is going to result on tariffs being much lower than that 125% level. The key question is whether the tariffs are going to end up being leveled on the phones, the entire value of the phones in Apple's case with the iPhone, or just the chips themselves, which is a much lower number. That's a key thing that we don't know yet.
There is a thought on Wall Street, led by Dan Ives, of course, the Uber bull from Wedbush around tech, that even just the volatility of not knowing for, say, 30 days could have a 10 or 15% hit on tech capex. In this kind of bracing of what tariffs come and whether they're sectoral or whether they're reciprocal or whatever that is, how much damage is this doing to tech companies that are actually trying to make changes and operate?
Well, tech companies are making decisions on a completely different time frame than the administration. As we were just talking about, the policies appear to change very dramatically over 48 hours at a time. When Apple is talking about building facilities to be able to make its iPhones, it has to make decisions on a decades-long basis.
Yeah.
Tim Cook is the guy who built this supply chain through China. He took a risk. He built these plants within China, making a bet that they were going to be able to produce there and ship into the United States. It worked brilliantly for a long period of time, but now what we're seeing is that these tariffs are going to force them to make some changes. Apple, of course, is shifting some production into India. One of their goals is to be able to make a bunch of the iPhones that they sell in the United States out of India and ship them in, but it remains to be seen whether they can do that for a very substantial percentage of their iPhones.
All right, Bloomberg's Peter Elstrom digesting the news just as we are drinking out of a fire hose, it seems, everywhere. We thank you so much for your time. Well, that market turbulence, of course, is not just in the tech space, it's in the banking space as well. Wall Street banks continue to report earnings with the results from Goldman Sachs due later today. Now, JP Morgan was part of the first wave of lenders reporting on Friday. On the earnings call, CEO Jamie Dimon warned of some of the market turbulence that Peter was just talking about. Take a listen to what he had to say.
You're going to hear 1,000 companies report, and they're going to tell you what their guidance is. My guess is a lot will remove it. They're going to tell you what they think it might do to their customers, their base, their earnings, their costs, their tariffs. It's different for every company, but I assume you'll see that. And anecdotally, a lot of people are not doing things because of this. They're going to wait and see.
Bloomberg's Charlie Wells is here to walk us through it. People are not doing things to wait and see. The words of Jamie Dimon, I mean, he's basically realizing the fears that everyone has. Everyone's just going to brace for impact.
This is exactly right. And I mean, it's funny if you compare that to what Ted Pick said on the call at Morgan Stanley, which was somewhat similar. And he was talking about how, we're seeing a pause, not a delete. And so there's this real kind of difficulty, I would say, maybe kind of somersaulting in how these executives this earnings season are kind of dealing with that uncertainty. And Bloomberg actually counted the number of times that executives on these calls said some variant of the word uncertainty, and it has skyrocketed compared to what it has been in previous quarters. So that really is kind of the theme of the day.
What do we get from GS?
Probably blowout on equities trading. I think that would be very much in line with what we've been seeing at these other banks. I think very much in line with what we've been seeing at these other banks. Who cares? Because I think there's two questions. One is the deal flow, right?
Yep.
Pause, not delete. I think we might see a similar theme at Goldman. But also, how they navigate this uncertain environment.
In some ways, they're a trading house in a way that JP Morgan isn't. JP Morgan is a much bigger cross kind of market bank.
Exactly.
Does this mean that Goldman Sachs is either better positioned or worse positioned? I can't quite work out which.
I think right now it's looking like bigger and more diversified is better. I think especially if the economy goes into a recession, which these executives have been really, really quick to say, no, we don't necessarily think this is happening, but we're ready for that. But I think in the event that that happens, the more diversification that you have, I think the better, particularly if those deals just are not paused and they are deleted.
Do they build out their reserves? Just very quickly, Jamie Dimon and JP Morgan talking about building out their reserves, and they did to the tune of almost $1 billion, but it wasn't that much.
No, it wasn't that much. And then also the things that they said were kind of not necessarily in line with a huge reserve build out, right? They were talking about the confidence of the consumer. And, Jeremy Barnum, CFO at JP Morgan, talked about how, as long as the labor market stays in a pretty healthy position, the consumer should be pretty healthy too. Wells Fargo also reported last week, and they talked about how the consumer is in a pretty good place too, which doesn't really jive with what we've been hearing about fears about inflation, fears about these tariffs and stockpiling, right? People, and also some data showing consumers are kind of paying the least amount that they have to on credit cards. So I think this all means it's really early days. We're not necessarily seeing that play out in the numbers yet.
Charlie, great stuff. Thank you very much indeed. We'll look forward to those numbers a little bit later on. As I said on Friday, I'm sure Sonali Basak will be all over that news a little bit later on in the US session. European banks, let's take a quick look at where we sit this morning. Generally up quite nicely. Deutsche is up by 4.5%. One of the best performers within the DAX this morning, which is being dominated by some of the tech names as we see that space moving higher as well. What are we going to be talking about next? Nouriel Roubini is going to be joining us. We'll talk to him about what he sees next. That's next. This is Bloomberg.
This is the opening trade, 30 minutes in today's session, and broad gains across the board. You're seeing this across the equity indices across Europe, higher by 2% on the stock 600. The outperformer is clearly the DAX. You're looking at massive gains for the likes of Deutsche Bank, SAP, Infineon. Buy everything seems to be the mantra in Europe, but does it stick? This is the equity picture. In the bond market, a similar one. People buying bonds across various regions here. I want to bring your attention to two key places. Italy, of course, getting an upgrade from S&P over the weekend. You're seeing a bid into that bond market as well as into the UK, that yield down by about 5 basis points, just as the currency rises across the board. Euro at 113, pound 131.
Yeah, off earlier highs though. We got a 114 handle a little earlier when it came to euro dollar. Let's focus our attention on what is happening in Europe, or what Europe is doing in the rest of the world. The European Union very much racing to try and get trade deals done with countries around the planet, looking basically to diversify. I can't talk this Monday morning. I blame Rory McIlroy. Against an increasingly protectionist United States. Let's get a take now from Bloomberg's Ollie Crook. Ollie, Sefcovic has been in the States. He's trying to get a deal done. He's trying to figure out what's happening. He's talking to other people. What is going on? Bring us up to speed.
Yeah, so Guy, Sefcovic is going to have his meetings in D.C. today with his counterparts and various other officials of the Trump administration. As you say, Guy, I think the real task for the European policymakers and European leaders here is to get a concrete idea of what exactly the Trump administration wants. We know what they want, broadly speaking. They want to close the trade gap between Europe and the United States. They talk about these sort of non-tariff barriers, all of these sort of other things. They need to get their arms around what the Trump administration explicitly wants from them, because up until this point, they have not really been able to. We also will have Giorgia Meloni. She'll be heading to D.C. later in the week. She is seen as sort of one of the political leaders here in Europe that has a sort of closest relationship with Donald Trump. Can they make any progress? And this all to bring some certainty to what has been a very chaotic system over the last couple of weeks. You had three basically different global tariff concepts that governed last week through a Monday, Tuesday, Wednesday, Thursday, and that is something they'd like to bring a close to. What I have gotten from all the finance ministers and trade ministers that I've spoken to over the last week or so has been that basically, despite the fact of whatever happens in the United States, the Europeans want to negotiate outcome. What is guaranteed is that Europe will hasten its efforts to build free trade agreements with the rest of the world. Remember, there's the Mercosur deal, which was sort of agreed to in principle at the end of last year. That is with Latin America. There are talks about free trade arrangements with the UAE. All of those things are still in motion. However, European leaders and European policymakers so far have stopped short of saying that they really want to completely reevaluate their relationship with China, which they still consider to be a competitor and really a threat to the European economy.
Well, Ollie, expand on that relationship here, because Pedro Sanchez has made, I believe, 3 trips in the last 18 months to China. Are we seeing any consensus being built around his position from some of his other European peers?
I think that he has failed to really get the European leaders and European policymakers to rally behind him in his effort to do that. We had to have him speaking, alongside Xi Jinping on Friday, and really starting to make the case for basically building a closer relationship with China, which he says, and I think which the Chinese say, in some ways a more reliable trading partner than the Trump administration right now. That being said, I will say that the Europeans are very reticent to basically throw out 80 years of diplomacy due to the way that Donald Trump has been sort of behaving over the last couple of weeks and months. Though, however, of course, Kriti, that could change as time evolves, right? In terms of the reality of what the actual Trump administration wants to get out of them. But for the time being, everyone I've spoken to, even the Spanish economy minister, was sort of putting a little bit of cold water on the notion that you'd have anytime soon a rapprochement between the Europeans and the Chinese.
Bloomberg's Oliver Crook there walking us through some of the European dynamics as they struggle to really balance the demands from the West, perhaps looking to the East. Let's continue that conversation about what's going on in China, specifically as we talk about this idea of whether they're prepared for this trade war. I want to bring in a true expert here. Diana Choi-Leva, chief economist over at Noto Economics, joins the program. Diana, a pleasure to have you as always. The conversation we've been having this morning is that we're seeing so much kind of tit for tat in terms of trade. How insulated is the Chinese economy right now from the ripple effects, from the impact of Donald Trump's tariff agenda?
Clearly, the all-out tariff war is going to hurt China, but China's had 10 years to prepare for this. And what we are seeing is Beijing basically realizing that there is no way to appease Washington. On the other side of the equation, there's also no way for China to really give the US what the US would want and reach this sort of grand bargain that we talk or maybe we hope for. So in the end, really, this is an all-out ideological great power competition that now is in the economic domain.
Diana, talk to us about then the market domain, perhaps, because we're talking a lot about whether or not, at the end of the day, the Chinese, even though they do have had 10 years to prepare, as you point out, are actively selling American assets. Are you seeing any evidence of that?
Look, I have not seen any evidence of that, but this is certainly something they can utilize, a weapon they can utilize in the short term. Over the long term, it's an own goal and certainly not something that they would like to deploy. They have been much more focused on diplomacy, actually, on that front, and on building and seeing an opportunity to expand their geopolitical sphere of influence.
Dana, good morning. It's Guy. Scott Bessent, the US Treasury Secretary, is using George Kennan-like language. He's talking about economic containment of China. In that kind of a scenario, does Europe have to pick sides?
Absolutely. Everyone will have to pick a side. And the reason why everyone will have to pick a side is actually technology. And no one is as ahead of the game in terms of technology as China and the US. So Europe cannot be a separate pole in a multipolar world. They have to pick a side.
So in terms of what we're seeing at the moment, there seems to be this belief within European capitals, in Brussels, that there should be outreach to China. Is that a mistake?
Look, it depends how you look at it. From my perspective, I've grown up in communism, and I personally don't want to live in communism again. It's important to me that the free, liberal, democratic world is as strong as possible. And actually, it will be able to be strong if the US and Europe work together, in particular with India as well in the mix. However, if the US is not prepared to work as a credible and reliable ally, Europe has no choice but to try and scramble and achieve some sort of independent strategic autonomy, but it really starts too late. So this is a very precarious position for Europe and could even lead to Europe's breakup, because there's certainly differences in the European capitals with respect to how to deal with Beijing.
Diana, when we talk about that kind of preparation for this restructuring of global trade, there's a question from a lot of major American, I would argue European corporates as well, that they don't want to stick with their supply chains in China, but reposition to the likes of India, Vietnam, Cambodia, et cetera. To what extent does that undermine the China bull case?
Look, the China bull case is actually at the moment has nothing to do with exports. What has happened in China is, for the first time ever since September last year, they're finally realizing they have to get their consumption going. And that's a very different story. On the export side, we have seen that the Trump administration in particular wants to close the loopholes of Chinese exports, basically round tripping through other locations in Asia. So it's no longer really a safe strategy for corporates to think about relocating to places like Vietnam or Cambodia. You have to really start differentiating or sort of dividing the world of where you think each country is going to fall, in which sphere of influence, and build your supply chains accordingly.
So okay, let's just take this a little bit further. A moment ago, you said that Europe could break up as a result of this twin power spheres of influence world that we are now moving into. Is that how big a risk is that? Could you see one part of Europe in the American sphere of influence and one part of Europe in the Chinese sphere of influence?
Look, I'm not an expert on Europe, but what I do see is that before the Russian war on Ukraine, actually that was a more likely outcome. I think post the war in Ukraine, China really lost Europe. Of course, Beijing is now in overdrive to try and take advantage of Trump's presidency. And it really depends on how the geopolitics fall out here and what happens both with America's position with respect to Russia's invasion of Ukraine as well as China's.
What kind of growth should we be looking for in a world that is as divided as you suggest that we may be, a divided scenario that we may be heading into? Globalization has had lots and lots of effects. As we start to unwind that, as we tear these two big superpower economic forces apart, what is the economic effect of that globally in aggregate?
It's stagflationary. And in particular, it's stagflationary in the inflation or stagnation part will, of course, depend on domestic policies and on the leeway or scope each country has to ameliorate this, invariably cost-push inflationary pressure from the breaking up of the supply chains. And so it's a very, very difficult situation for the global economy, one where it's difficult to foresee how the chips will fall. You know that I have been talking about the great decoupling since 2017 and sort of foresaw everything that we are seeing right now. At the moment, we are in the eye of the storm.
Chips falling, I guess that is the story right now. The chips are the story. Diana, always great to catch up. Thank you very much indeed for joining us. Diana Choileva, Inodo Economics Chief Economist. We're going to be back with more. We're going to carry on this conversation. That's next. This is Bloomberg. Monday morning, good morning. It's 14th. You got European equities a little bit higher this morning. I say a little bit higher. We're up by circa 2%. Tech's having a reasonably good morning. You're seeing pharma stocks doing reasonably well. Actually, some of the commodities stocks are also doing fairly well as well. We are, though, keeping a very firm eye on what is happening with the dollar. The buck is under pressure. Euro's been in and around 114 for most of the morning. You've had a fairly big move in Japanese 30 years as well, which is worth paying attention to. There's a lot of different forces kind of moving around at the moment. So let's try and pull them all together, try and get some signal out of the noise. Nouriel Roubini, CEO of Roubini Macro Associates, joins us now. Nouriel, good morning. Let's talk a little bit about signal and noise. How much signal are you able to see at the moment in all the noise at the moment? What are you watching to figure out what happens next?
Well, there are three scenarios that are important for the global economy markets. One in which you de-escalate not only with friends and allies, but also with China, and you start negotiation. If that's successful, then you avoid the U.S. and global recession. Markets are going to be higher all over the world by the end of the year. The other extreme scenario is one in which there is a failure of negotiation, even with friends and allies, let alone with China. Then we end up in the U.S. and a global recession, an ugly one. But the more likely scenario is the middle one in which you have successful trade negotiation to de-escalate with Europe, Japan, Taiwan, India, South Korea, and you name it, but not with China. And if you don't start negotiation with China, the trade level of tariffs are such that then inflation is much higher in the US, there is a growth shock in China, and you can still get a near recession in the US and in China that then damages the world economy and damages the market. So I think that, unfortunately, we're in this limbo right now. There is a chance the U.S. and China may start negotiations. If they do start negotiations, they could try to reach a grand bargain. But the ask of the U.S. out of China might be too much for China to accept. So those negotiations may still fail.
Nouriel, what's on the table here? You think about the kind of the spectrum of what we're thinking about. Bessant's talking about what sounds like, as I was just talking about, Kennan-like containment of China, that we're basically going to tear the global economy into two competing spheres of influence. He wants to use the rest of the world to ring-fence China and to isolate China. In that kind of a world, how long is it going to take? How long is it going to take to get to a steady state in which we don't have the kind of volatility that we've got now? How long is it going to take to reorder the global economy into that kind of a new world?
Well, if you're really trying to contain China, it's not just a trade war, but restriction to technology, to financial activity, to investment both ways, and so on, imply a strategy of full economic containment of China, what China is really worrying about, that the US is trying to prevent the rise of China. If you do that, you have a risk of a true war, because the only thing that is constraining China from going and trying to take over Taiwan, either through an invasion or a blockade, is the fact that they know that the US might punish China by doing what they've done with Russia, meaning total trade embargo, no economic activity with China, and that would be highly painful for China. But if you are going to a world of trade tariffs of 145%, of full economic containment, then that leads to a trade war that becomes an economic war, that leads then to this Cold War becoming colder, and eventually a hot war in the case of Taiwan. Why should China restrain itself with Taiwan and not take it over if it is losing the global markets of the US? Might as well start to do that. And it's not obvious that the US is going to reply to that by breaking a blockade, because that's not just a war with China. It's not just a conventional war with China, because either side is going to either win or lose, and then it becomes an unconventional war, and then it's the end of the world. So those who think that they can contain China, I think they're really playing with fire, because that's very, very dangerous. What you can do is to do a grand bargain with China, where you do a deal where you de-risk the relation of China by decoupling in technology, because the things that are critical to US and China, there has to be full decoupling, but then you do trade on everything else. We don't care about Chinese toys or consumer products being cheap in US. We're worried about advanced tech or EVs or semiconductors or things of that sort. So if you reach a grand bargain, then you still have a division of the world in two, but it is a technological division. It is not a full decoupling, it's de-risking what's important.
Well, Nouriel, walk us through then the levers that China can use here. There's a lot of speculation about whether or not China is selling treasuries, whether they're looking to devalue their currency further. What kind of response can we expect from China in the days and weeks to come? As you point out, the U.S. looks to contain it.
Well, there are things you can do for the domestic economy. You can do massive additional fiscal stimulus. You can do further monetary easing. You can gradually weaken your currency, but of course, with tariffs at 145, if you let your currency so much lower, then there is a risk of capital flight in spite of capital control. You can do structural reforms to reduce the savings rate and increase domestic consumption. It implies to creating a social safety net. You're already replying to the US by imposing tariffs of 125%. Of course, given the trade imbalance, the US hit on China is worse than the one that China can impose on the US. But then there are lots of other things. You can shut down the exports of rare metals to the United States. Most of the refining of even industrial and green metals like copper occur in China, not the production, but the refining. You can shut down that. You can go after Tesla. You can go after Apple. You can go after hundreds of billions of dollars of US economic interest and FDI in China. You can do lots of things. And as I said, you can then become more aggressive with Taiwan as well. So there's a whole spectrum of things China can do. By the way, China and Xi Jinping do not face election. Next is the midterm election in the US that could lead, if there is an economic recession, to the MAGA project failing miserably. He can wait out the United States. So in the short run, China has a lot of leverage. In the medium term, of course, a trade war like this hurts China more than the US, because China is exporting 2% of its GDP to the US. If that goes to zero, it's a huge economic shock.
Well, Nouriel, in terms of the economic shock, I'm curious about, I mean, you just laid out all the levers that China can pull. To what extent is the volatility around these tariff announcements doing more damage than the rate itself, in that corporations from both sides of the Atlantic and both sides of the Pacific are just trying to work out what the number applied to some of their goods actually is? How much of that volatility and that bracing for impact is amplifying the odds of a recession?
Certainly, the volatility on top of the tariffs increases the uncertainty, and there is an option value of waiting. If you're a corporation, you may say, let me wait and see until I do more investment, more employment, more domestic or foreign investment. Same thing for consumers. But it's not just the volatility and uncertainty matters, because the level of tariff matters. I mean, if we end up with certain economic tariffs by the U.S. against China of 145%, and you're certain about them, there's no uncertainty, the economic pain is severe, regardless of. So this argument is all about the uncertainty. If we only knew what the tariff will be okay, is not true, because if the tariffs against Europe, Japan, China, India, and others remain very high, there is a huge economic and financial market damage, even if there is zero uncertainty. So it's not just an uncertainty problem, it's also the economic damage of this trade war that is a problem.
Yeah. Nouriel Roubini, CEO of Roubini Macro Associates. Oh, losing my voice there. We thank you so much for joining the program. Of course, as we were talking then about what that volatility actually looks like, that uncertainty that Nouriel was just talking about, how do you position for it? Let's bring in Bloomberg's Valerie Teitel, who is trying to work that out. Val, what do you do?
Buy gold. I think that's what the market's told us. I mean, just take a look at how gold's been outperforming. I mean, even on a 5-year historical basis, now outperforming the S&P 500. You know, I say that with a laugh, but at the same time, you know, gold can be telling us various things, Guy. And I think perhaps maybe one of those things it's telling us is that there essentially is a risk that the U.S. tries to inflate away their debt pile, and that perhaps these treasuries end up being on the Fed's balance sheet because, frankly, if they're not going to foreigner investors, if they're not going to banks, where else are they going to go?
Who else is going to buy them?
Yeah, exactly. And I think that, the Treasury Secretary, Scott Bessent, was speaking to Fox News this weekend, and he was talking up the prospect of banking reform in order to allow banks to hold more treasuries. So maybe there is a start of realization that they need to get going on this kind of banking regulation.
Good for banks or bad for banks?
Well, you could argue it's bad for U.S. growth, right? If U.S. banks are in some way, maybe not forced, but in some way are more pursued to hold more treasuries on their balance sheet, they're doing less active lending to other parts of the economy. But at the end of the day, if that's growth negative, this goes into that whole debt circle discussion again. Your debt to GDP rises, which means you need to cut government spending, which means you have more treasury supply that needs to be absorbed by the market.
How quickly does that happen?
That is another good question. Yeah, no, that's another good question. I mean, we saw these same dynamics happen in the UK around the Liz Truss scenario. And I think the big takeaway from that is that the bond market, the government bond market, is too big, and you need to be careful about trying to change the boat over what kind of growth you're going for, right? And with President Donald Trump, trying to rewire global trade, reducing the trade deficit, is really posing questions about the buyers of treasuries. The same kind of question that we had here in the UK around the Liz Truss epidemic. But I'm starting to get real concerned about this kind of price action, especially if we see on a day like today where they've done some tariff reprieve and we still have 30-year yields trickling higher. It does not put us on a good firm footing going ahead.
I feel like we had this conversation in like the third quarter of 2023, and here we are.
Here we are again.
Yeah. And really the dynamics haven't changed. We just have a different president, which is fascinating. Bloomberg's Valerie Teitel walking us through some of these markets. We thank you so much. And speaking of that bond market, the behemoth that, of course, is driving a lot of these other ripple effects, we're going to have an exclusive conversation that's incredibly relevant. U.S. Treasury Secretary Scott Bessent will be joining Bloomberg TV this afternoon. You can catch that interview on television, I believe on radio as well. Our very own Anne-Marie Hordern in Argentina for that. That does it for the opening trade. The Pulse is up next. This is Bloomberg.